getting in and out and trying to be a day trader as a retail investor is a sucker's game today, right? Because of these bots and because of the quants and high-speed trading, high-frequency trading. This kind of stuff makes it impossible for a retail investor to compete writ large, yeah?
It's very tough. Knox is, considers himself a trader. I do not. I'm writing, in-depth analysis that I don't budge on for years. I mean, that's kind of my niche is that if I'm writing about the company, I'm ready to go to bat for it. I'm ready to take on the market. Like I know the market is going to come for me and it's going to tell me I'm wrong. And my thesis is this, in price movement. So, I've held personally, and then the IO fund has also held companies that had 50 to 60% drawdowns. I mean, one of our, classic calls was Roku at $30, and it looks like a darling today, but there were many times that Roku was down. I think 3 times in the last 3 years, Roku was down 60%.
Roku seems like the most impossible bet to make to me as a venture investor, because you have Apple TV as an incumbent, you have Google as an incumbent, and then you have these other big streaming services who, maybe they don't have hardware yet, but maybe they could buy something. And so walk me through how you have the audacity when something like Roku is trading at $30 a share, a couple of years ago, to say that company can compete against the duopoly, Google and Apple, and then Amazon. All 3 of them, well, actually 2 out of the 3 do not care about margin on hardware. The only one who cares about margin on hardware is Apple. So you're up against 3 giants who don't care about money. And Roku does the same thing. How do they win?
I think that's a great question. And audacity is a great word for it, because the Wall Street will always make you think that you're wrong. And so you got to be really firm on why you might be right. And so all of this has been carefully written about. But I would call Roku technically the incumbent here, because they were the first to market. And they actually came out around the same time as Reed Hastings with Netflix. So it just took this long for ad supported to come out, AVOD. Versus subscription video on demand, to be picked up specifically not by the cord cutters, you and I, but by the brand advertisers. And so the other thing is that they own the whole stack, which Google owned the whole stack and Amazon eventually got into, but they had designed an operating system that was flawless for very cheap. And it fits well into low cost television sets or smart TVs. All that is great because they have this hardware and they have the operating system that they can do very well with. But ultimately, Roku's path to a lot of Wall Street gains still is today, is that they are an ad platform. So we are moving into a world where brand advertisers, which are on, pay TV, linear pay TV, are moving on to they're cutting, they're moving towards the cord cutters. So they're going over to OTT. So Budweiser, for the first time, did not advertise in the Super Bowl. They are moving over to Roku. I mean, Roku and its competitors, those brand dollars are actually worth as much as mobile. Pay TV ad dollars have been a holy grail for some time. So you're talking your Pizza Huts. Pizza Hut can't really advertise on Facebook as effectively as they can advertise on a television screen. And if you can add in the data that comes from you viewing OTT, set-top box or smart TV, Roku's, Android, Google, that data is now informing your Pizza Hut ads, your Budweiser ads, whatever it might be. That's a big deal for pay TV advertisers who did not budge and did not spend on mobile very much. So it's a budget migration.
Yeah, it takes a really deep analysis of that, because what you're also realizing in all of this is, okay, sure, hardware is a commodity, but audience is not, right? And the ability to aggregate an audience together like that, even though you can commodify the hardware, there was another trend going on, which is, I don't know if you've had this experience, but with my NBA League Pass, there's an option to turn off ads. Hulu, I can turn off ads. HBO Max, no ads. Netflix, no ads. Disney Plus, no ads. So I'm looking at consumers and thinking, wait a second, the highest end consumers are opting out of advertising across some of these top platforms. Like, when's the last time you saw an ad, right? And I actually pay for YouTube. I don't know if you do this. Do you pay for the YouTube premium service that takes ads out? I'm curious if either of you pay for that. Oh my God. It's the greatest bargain in the history of media. You don't know how many YouTube ads you're watching, but my Lord, just not having to skip the ad after 5 seconds, 20 times a week or a day or however long you're on there. It's incredible. So where do those advertising dollars go? Roku, right? Like it's a really interesting funneling there of consumers.
Yeah, and I guess the other way to reframe it is that technically Roku has always had the biggest audience by a small lead. But how were they able to do that for so long with Google and Amazon chasing them? And Apple TV is, I'm not even sure if are they producing much for that anymore? I don't even know. They didn't do well. It's known to have not done well.
I always thought, this is a very weird thing about Apple, like for them to do content always seemed like strange to me because they're not willing to do the content that a lot of people would want, which is adult fare, FX, HBO, Sopranos, Game of Thrones just wouldn't work on their platform because they're unwilling to show sex or violence to that level, right? They want Ted Lasso stuff. So I don't understand Apple's mission there, I guess.
They have to do something with that money.
Let's talk about that. You have these giant war chests. What is the story with these? How do you value companies and their usage of capital in relation to M&A and putting it to work? Because, Beats was a completely uninspiring acquisition. Is Tim Cook a great CEO for not acquiring companies and staying focused and making sure everything's built there? Or is this a huge mistake? How do you think about that with Apple specifically? I'm curious.
The price keeps marching higher. So regardless, I guess, of what I think, Apple has done very well with Tim Cook. But if you were to, ask me casually, what do I think of Tim Cook? And I'm not a big fan. I have never, and it's really important to always stick to your thesis as an investor, which means someone just put on Twitter the other day, Peter Lynch, like you've got to be able to sit back and watch other people make money on what you passed on. And I'm okay with passing on Apple, even with the gains, because I couldn't find the growth market for the company. I get it. iPhones, high dollar, average sales price, et cetera, but great margins, cash machine. This company's a cash machine. I just can't find the growth market, and that's my investing style. So even with all of that cash, I don't know the growth markets that Apple is going into in the near term. And that's why I stayed away recently.
In today's startup landscape, committing to security and compliance is vital for growth, and proof of your company's security posture has never been more important. As you scale, you might start to receive more SOC 2 requests from customers, and that's where Drata comes in. Drata is an advanced automation platform used by some of the world's leading chief information security officers, or CISOs. Drata will help you successfully meet requirements, support enterprise deal flow, and continually track compliance. Drata also helps customers easily prepare for and clear SOC 2 and other audits, so you can go from zero to audit ready in a matter of weeks. Need more? Take it from Philip Martin, Chief Security Officer at Coinbase. And here's his quote. "It became clear to me right away that Drata is an engineering powerhouse. The solution they've developed is well ahead of other market players. Their approach to deep native integrations provides users with the most advanced automation available." So check out Drata's 5-star reviews on G2 and see why companies like ClearClose, Smart Recruiter, and the Good Face Project work with Drata for their compliance needs. Twist listeners can get 15% off and waived implementation fees at drata.com/twist, DRATA.com/twist.